I've been recommending Juicy Smollett, and Brie Larson. The analyst community is, as far as I can tell, the Wall Street, Bay Street equivalent of Labrador Retrievers. They just love everything. It's love, love, love. So that's $29,000 million. Of course, Dungeons and Dragons. You could get into D&D if you were looking for some entertainment in your life. When it happens, my prediction, you're hearing it here first, is that within 5 years, CP will take a massive goodwill write-down. That's going to hurt their earnings. Now, that may or may not affect their stock, but the fact of the matter is they are overpaying for this asset. Talking about stocks, me sitting here talking about stocks, if this is entertaining to you, down here at ringside, CP's beating up on KSU, and oh my god, pandemonium! So really it's about feeding my ego, which is my primary motivation, which indicates that this series is probably going to continue till long after its best before date. Scroll mishap effects, you were just getting crazier with each edition. Oh, hello. I'm sorry I didn't see you there, nor did I see the colossal light that you wheeled into my painting man cave. Welcome. Just reading my Dungeon Master's Guide. Dungeon Master. It's not a title they bestow on just anyone, but Master. Anyway, now that you're here, welcome back to Capital Rev. I hope everyone's well and healthy. So today is the first of a series I want to start where I talk about individual stocks that exemplify a particular point in market history. And the reason I want to do that is because I think it's far more concrete a thing than what I've been doing so far, right? So I can talk about valuations, I can talk about margin debt and slowing earnings and all this other stuff in the abstract. But I think it's much more powerful actually to point to a story, an anecdote, and say, okay, this is actually happening. This is a thing right now that people are doing with real money, or managers are using real investor capital to do this thing. So that I think indicates where the market's head is at, right? So that's why I want to do this series. Really, I've got two motivations for it. The first is far more important, and that is I, like every other content provider, want to have a positive track record that I can point to and look back at and say, had you done this when I told you to do this, you'd be better off, or had you done that, you'd be less worse off than you are now, really. So really it's about feeding my ego, which is my primary motivation, which indicates that this series is probably going to continue till long after its best before date. And the second reason, I think it may be educational for you. It may actually help guide you on your investment in economic decisions in future. So I hope you find it interesting. So the first of my stories is going to be about Kansas City Southern Railroad, or KSU for short. KSU is its ticker, so when I talk about it, I'm probably going to use the ticker because it's easier to say. But KSU and CP and then CN, right? So Canadian Pacific Railroad and Canadian National Railroad. The drama around those three railroads is what I want to talk a little bit about today. So I think it was back on the 21st of March when KSU and CP announced that they were going to merge. And the terms of the deal are pretty straightforward. It's going to be $25 billion in stock and cash, and CP shareholders or owners were going to take on about $3.8 billion of KSU debt, suggesting that the terms of the deal were going to be for an enterprise value of about $29 billion. So that's $29,000 million. So that's a lot of money. So another fact that might be relevant later on is that KSU will have to pay CP $700 million as a breakup fee if the deal doesn't go through. Instantly, the analyst community loved the deal because the analyst community is, as far as I can tell, the Wall Street, Bay Street equivalent of Labrador Retrievers. They just love everything. It's love, love, love. We love it. Love it. So you're going to merge? We love it. You're breaking up? We love it. We're just love. That's the analyst community. So they loved the deal. A couple of weeks later, Kansas City Southern did what it has been doing for a very long time now, and that is they released disappointing earnings. And 5 days after that, Canadian National Railway jumped in the ring. So it became like a Wall Street wrestling match or something. It's just like, down here at ringside, CP's beating up on KSU, and oh my god, pandemonium! CN Rail has just jumped in the ring. It's CN beating up on CP, CP beating up on KSU, KSU doesn't know who to beat up on, going crazy. It's pandemonium down here at ringside. Okay, so to sum up, in the dying days of March 2021, CP and KSU announced that they're going to merge. KSU will have to pay $700 million if CP doesn't actually get together with KSU. KSU releases earnings that are, of course, disappointing. Canadian National Railway decides to, step into the fold and actually put in an offer to buy KSU as well, a much sweeter offer. I think it was for $34 billion. I'm not going to talk so much about the CN deal because I think the CEO of CP is actually correct when he says that it's fantasy land. In all probability, CN knows that the Surface Transportation Board, the regulators that look after this stuff, would never allow a deal between CN and KSU. They're just CN's just sort of throwing a monkey wrench in the deal to make it more expensive for CP to buy KSU eventually. Okay, so CP wants to buy KSU for $29 billion. Prompts the question, why are they doing that? And for my part, I actually have some sympathy for the management team at CP. Right, so unlike their Canadian competitor that touches 3 coasts, right? So CN Rail touches the Atlantic, the Pacific, and the Gulf of Mexico. CP has far less access. They have very, very little access to the American heartland, and they don't get anywhere close to the Gulf of Mexico. Also important is that CN Rail, in addition to touching all 3 coasts, because Hunter Harrison back in the day bought EG&E Railroad, CN is allowed to bypass much of the bottleneck that is the city of Chicago. And that's important because train speed really, really matters. And the city of Chicago is a huge bottleneck, right? So to put that in perspective, it takes as much time for a train to travel from Winnipeg to the north side of Chicago as it takes to travel from the north side of Chicago to the south side of Chicago, right? So like Chicago is this giant bottleneck, has been for years. And the fact that CN can bypass it or largely bypass it gives them a huge strategic advantage in terms of the velocity of their trains relative to everybody else. So I can understand why CP's management actually wants to buy KSU. The problem is that this thing, like with many things, the devil is in the details. And so let's get into the details, shall we? Okay, so we know that CP is willing to pay $29 billion for this asset. Is that a good price or not? Well, this asset, KSU, is like any other in that whether it's a good buy or not is really determined by whether the cash that the asset spins off is equal to or greater than the cost that you paid for it. So let's imagine you run a lawn care company, and I'm thinking lawn care because I hear the leaf blower outside, the leaf blower that's been going non-stop for the last 56 days, I think. But let's say you own a lawn care company and you have the option to buy a lawnmower for $2,000. Whether that's a good buy or not really comes down to whether the net cost of running that lawnmower and acquiring that lawnmower is less than the cash that you can, generate from, employing that lawnmower, right? So really an asset is a good buy or a not good buy depending on how much cash you can spin out of it, right? So that's really the first thing we should think about when contemplating this $29 billion. Now, for your enjoyment and edification, dear viewer, I've actually gone to the trouble of producing or reproducing KSU's financial statements for the last several years, and a few things pop off the page, at least to me. First, not a lot of growth in this sucker, right? So this is sort of like go low, take it slow, do not grow kind of business. So it's good for between $600 and $650 million a year. That's the second thing that, leaps off the page to me, right? So KSU spins off between $600 and $650 million a year in terms of net earnings, which is the residual cash left over for owners of the business. Knowing that, we can then go back and ask the question, is $29 billion a good price to pay to acquire $600 to $650 million in net income? Well, a way to think about that is to sort of compare it to other things you can buy, right? Because in the world of investing, because money's fungible, everything is a good decision or a bad decision relative to everything else, right? So $650 million divided by 29 billion, we know is about 2.24%. The risk-free rate on a long-dated US government bond is about 2.3% right now. So investors or the owners of Canadian Pacific are buying this asset that generates less than the risk-free rate of return. So if I were a CP shareholder, I would go to the next board meeting, put up my hand and ask the question, why are we spending $29 billion on an asset that spits out between 600 and 650 million, right? Because the yield on that asset, this capital that we've spent on this thing, we owners of this business, is going to earn us less than we could earn if we just bought some government bonds and went fishing. because they have a pathological need to defend every decision they make, the management of CP at that point would roll out the analyst expectations that there's going to be $260 million of synergies created as a result of this merger between CP and KSU. We have to ask ourselves, okay, is the analyst community correct? Are we going to generate an extra $260 million a year in synergies from this merger between CP and KSU? Well, let's put that all in context. First thing, as we know, because I've just told you repeatedly, KSU is good for about $600 to $650 million a year. And CP is good for about $1.8 billion a year. So combined, those two railroads, holding all else constant, are good for about $2.4 billion per year. 260 million is about 11% of that, right? So putting this $260 million of synergies from the analyst community in context, we have to ask ourselves, okay, so A by itself generates 650, B by itself generates about 1.8. Putting them together is going to generate not 2.4, but it's going to generate 2.65, something like that. So it's going to be 11% more efficient when they join together. And I think that is a wildly optimistic forecast for a couple of reasons. So the first and most obvious thing to point out is that most mergers and acquisitions fail, right? So management, they have big egos, they want to build empires, they splash around this investor capital knowing that it's not really their money, it's your money, Mr. Investor. And so they'll overspend on things in order to empire build and feed their ego or whatever. And as a result of that, when you overpay for an asset, eventually bad things happen. So that's the first problem. Most of the time, mergers and acquisitions fail. There's a lot of data and a lot of research to back up that claim. Second thing relates more specifically to railroading in particular, right? So when you think about a railroad, there's no railroad that spans all of North America, right? So there are seven Class 1 railroads in North America. One of which is private, or it's owned by Berkshire Hathaway. The others are Union Pacific, CN, CP, KSU, CSX, and Norfolk Southern. Right, so there's 6 publicly traded railroads. And what you find if you do a bit of digging into the history of this is that when an innovation happens at one railroad, it's quickly adopted by the other railroads, or adapted by the other railroads. Not sure which, whatever. Adopted or adapted. Either way, the other railroads copy, right? So whether it's just-in-time railroading under Hunter Harrison brought that in, every other railroad instantly cottoned onto it. Whether it's double stacking your rolling stock, and so as a result you need to make your tunnels bigger, every other railroad did that. Double track, positive train control. So the idea is that with railroading in particular, there's a kind of co-opetition that these companies engage in, right? So they have to compete against each other, but if there is a value creating activity like just-in-time railroading, positive train control, double stacking their rolling stock, whatever it is, they will kind of like all copy that at the same time. So given the culture of railroads, the fact that they need to cooperate in very real ways, if KSU and CP determined amongst themselves, hey, I'm doing this, you're doing this, but if we got together, if we did certain things together, we could generate an extra $260 million between us, and we could divvy it up however we deem to be fair, they would have done it already, right? So what the analyst community is asking you to believe is that there is a $100 bill lying on the sidewalk that no one's picked up yet because there hasn't been a merger. But the fact of the matter is that if these companies, given their culture, if these companies had a way to boost their profit by cooperating with each other in a specific way, they would have done it already. So the idea that there's going to be $260 million of synergies from this deal is ridiculous, right? So they may get some savings with IT infrastructure, and they may get some savings, or they may be able to generate some extra revenue with cross-selling opportunities. But $260 million, I mean, I was born at night, but I wasn't born last night. Okay, so before wrapping up, I need to sum up. So CP has put in an offer to buy Kansas City Southern for $29 billion. CN spoiled that offer by raising it, and so maybe CP is going to have to come back to the plate with a higher number. Don't know, but in all probability, this deal is going to go through. When it happens, my prediction, you're hearing it here first, is that within 5 years, CP will take a massive goodwill write-down. That's going to hurt their earnings. Now, that may or may not affect their stock, but the fact of the matter is they are overpaying for this asset. I think the asset's probably worth, I valued it myself, between $13 and $15 billion. So they're wildly overpaying for it in my estimation. I think CP's management is kind of betwixt and between here, though, right? So they have to do something. They have to acquire another asset that will give them access to geographies that they don't currently service, but I think they're doing it in the wrong way, frankly. Okay, that about does it. Wraps are all up. Thanks very much, as usual, for watching. The purpose of this video is obviously for informational and entertainment purposes only. If you found it informative, as usual, I'm happy about that. If you found it entertaining, I've said it before and I'll say it again, you got insane taste in entertainment. There's much better, much more entertaining stuff out there. I've been recommending Juicy Smollett and Brie Larson. Anything therein I find massively entertaining. Of course, Dungeons and Dragons. You could get into D&D if you were looking for some entertainment in your life. This, talking about stocks, me sitting here talking about stocks, if this is entertaining to you, that's crazy. Okay, that's about it. See you next time. Goodbye.
Birds come and cry there and twitter in the chimney, but I go forever and come again.